Hi, I'm Pattu from FreeFinCal. I had run a poll on Facebook group Asan Ideas of Wealth, where I am reasonably active. It's not my group; it's run by my friend Ashal Jowri. If you are not part of the group, you ought to be. So I had asked the group in November 2019. Let me look at the date. I think it was November 18th, 2019. That's a good 3 months before the market crash. I had asked the group if the average first time investor realized just how much risky the stock market is and that there is no guarantee of long term success, would they invest in equity mutual funds? And would you believe it? Out of the 361 members who had participated in the poll, 284 or more than 78% of them said if first time investors appreciated risks, they would not buy mutual funds. And that's really amusing, and especially because at that time the markets were pretty much close to their all-time highs or whatever, and we were very far away from what is currently happening now. That's the so if I were to redo this poll now, I wonder how much worse the results would be. So the point is, so what is the solution here? The simple reality is, first let's talk about that. The simple reality is mutual funds are sold based on past performance. Although there is a disclaimer, they will say, "Oh, look, this got last 10 years, this is the return. Last 15 years, that's the return." And they will say, "In eventually the stock market will move up. You just need to calm down and hold on." And that's essentially the mantra of selling mutual funds. Entice people based on past returns and make them stay invested, because if they run away, you lose commissions, you lose profits on expense ratios, and so on. So the big problem here is people are buying based on past perception. Now, if you look at, I would like you to do this. I will do a post myself, but you can do it. Go to AMFI AUM history, or search for AMFI AUM history on Google, and you will find that the between 2009 to 2013, the AUM of the industry never grew. The reason for that is because the stock market was more or less trading flat. That's the big problem. Investors always put in money, they rush to the market only after they see the returns. They see the returns and rush in and get into the market. That happened. I have a post on, does size of a mutual fund affect its performance? I don't have a video on this. This was done many years ago. I had shown that the AUM of HDFC Top 200, at that point of time it was called that, HDFC Top 200 and HDFC Equity, the AUM zoomed up after the market recovered from the 2008 crash. So after the Lok Sabha elections of 2009, when Manmohan Singh was re-elected, the markets recovered, and after the recovery, people pushed in money into these funds and of course other funds. This is what is happening. People are always investing based on past performance because they are being sold based on past performance, and when they realize the real risks, they run away. Look at what has happened in the space of 1 month. We now know markets can go down any lower, any amount in any day. We know that balanced advantage funds can also crash during a market crash. We know liquid funds are in danger. We know overnight funds have risk. You name it. We have seen 10-year returns of Nifty, SIP. Oh, the great SIP are in single digit now, less than an SB account actually. So it's quite unfortunate that people are sold mutual funds for wrong reasons. They're shown wrong data, and the big problem is the risk appetite of the individual is not analyzed. In my opinion, risk appetite means what is the risk awareness of a person, and this is where how much does a investor, especially a new investor, appreciate and understand risk in the capital markets should be evaluated properly. In my opinion, the existing risk evaluation methods that are based on kind of objective type, based on behavioral ideas and behavioral research and so on, is wrong. It's misleading and can give especially advisors the wrong opinion. And this is one of the reasons why I want to come up with my own risk awareness test, or product, if you want to call it. I do want to keep it low cost, but that's not the point. I don't want to. I mean, I've still not yet actually put it into formulation. I want to in the next few days. But the point is, people are buying without understanding risks. And if they understood risks, well, many people will run away. They will run away because they don't have a plan. My point is, I'm not saying don't invest in mutual funds. I'm saying the same thing in over and over again, just like a chant. And people say I don't offer solutions. I am offering a solution. The solution is invest in mutual funds in spite of all these sales guys and all these AMC guys who talk this and that on Twitter, who keep saying this too will pass. Only farts will pass. Market risk will not pass. Uh, the point is that invest in spite of them, but invest with a plan. If you have a plan, you can navigate and negotiate this market risk, even minimize it, and get money that you want for future goals. I have plenty of resources for it. Some of it is paid, some of it is free. You have to explore with Free FinCal to get it. A smart guy will get everything that's there to be said on goal-based investing already available at different points, at different blog posts at Free FinCal. Go take a look at it and let me know if you have any specific questions that you want to be answered, and I'll do. So catch you later. Bye bye.